Mercado Libre's Q1 2026 earnings print just dropped, and man, did it generate a massive amount of noise in the market. Welcome to our latest explainer, where we're undertaking a highly analytical, objective deep dive to cut right through all that static. Today, we're evaluating the structural tension between MELI's explosive top-line growth and their rapidly rising liabilities. Our goal? To give you, the institutional investor, a crystal-clear, data-driven picture of what is actually happening beneath the surface of this report.
So, here is our roadmap for the analysis. We're going to define the Mercado Libre paradox, break down the Q1 income performance, and take a really hard look at the margin compression and liabilities funding all this growth. Then we'll examine the Mercado Pago credit boom and wrap up by weighing the dueling institutional bull and bear theses.
All right, part one, the Mercado Libre paradox. Let's start with the central cognitive dissonance of this quarter.
To understand this company right now, you really have to reconcile two entirely different financial realities playing out at the exact same time. The immediate disconnect is just striking. On one side of the equation, you have a massive revenue beat, surging 49% year over year. Yet, juxtaposed right against that fundamental strength, the market heavily punished the stock, dropping a near 30% drawdown from its 52-week highs. It's a total paradox.
And we see this paradox deepen when we contrast the bottom line with their actual cash generation. Mercado Libre missed analyst estimates, reporting GAAP earnings at $8.23. But if you look past that headline miss, free cash flow absolutely exploded. It hit $1.8 billion for the quarter, up from just $759 million a year ago. I mean, the cash is literally flowing at nearly 10 times the reported net income.
Moving right along to Section 2, Income Performance. Let's unpack the sheer volume of this commercial growth.
The crucial anchor point here is $8.8 billion in Q1 revenue. Now, as CFO Martin De Los Santos pointed out, this 49% year-over-year increase isn't just good, it is their highest growth rate since the second quarter of 2022. The commercial engine is clearly firing on all cylinders.
What's really fascinating about these numbers is a uniform strength across the entire region. Looking at gross merchandise volume excluding FX impacts, Argentina was up 41%, Chile 40%, and Mexico 28%. But the real heavyweight standout here is Brazil. Driven by some highly strategic shipping adjustments, items sold in Brazil actually shot up 56%, which drove a 38% GMV growth. The engagement acceleration is truly ecosystem-wide.
But, as we know, all of this top-line growth does not happen in a vacuum. Let's pivot to Section 3, Margin Compression and Liabilities, to figure out exactly what this growth is costing them.
Okay, let's focus on this number, 6.9%. That is the operating margin for the quarter, and frankly, it's what spooked a lot of investors. Because while revenue was up 49%, operating income actually declined 20% year over year. But management has been incredibly transparent about this. The CFO explicitly guided that this reflects a deliberate 5 to 6 percentage point margin hit. This isn't an operational accident, it's a highly calculated choice to sacrifice short-term profitability for long-term market share.
So where exactly is that money going? There are 4 specific deliberate investments generating that margin compression. Number 1, they're lowering the free shipping threshold in Brazil. Number 2, aggressively expanding credit card issuance across key markets. Number 3, heavily scaling their first-party retail. And number 4, building out cross-border trade infrastructure from China. Every single one of these has a measurable strategic growth output.
Obviously, when you offer more free shipping to capture the market, your liabilities are going to skyrocket. And the SEC filings detail exactly that, a massive $1.9 billion surge in shipping and carrier operating costs. Plus, as the sheer volume of payments grows, we're seeing a $533 million rise in collection fees. They are quite literally eating the upfront cost of logistics and payments to fortify their network effects.
Which brings us perfectly to our 4th section, the credit boom. We really need to shift our focus to the fintech side, Mercado Pago, and its rapidly expanding footprint on the balance sheet.
Just consider the absolute scale of this figure. We are looking at a $14.6 billion credit portfolio. This loan book has nearly doubled year over year. In Q1 alone, they issued 2.7 million new credit cards. Credit card total payment volume is up 90%, and assets under management surged 77%. It is a massive land grab.
But as analytical investors, we always have to pause and pose the critical question: at what cost?
What are the systemic risks associated with such rapid, aggressive credit expansion, especially in emerging markets? Objectively, the cost of this credit boom includes surging financial liabilities. The filings show elevated fintech costs, which are primarily driven by much higher funding costs needed to support all this lending. Furthermore, it's just math. As the consumer credit portfolio grows, they are required to expand their provisions for doubtful accounts. It shows a disciplined underwriting approach, sure, but it undeniably puts heavy pressure on current margins, while these credit cohorts take time to mature.
So we've got hypergrowth funded by deliberate margin compression. This leads us directly to our final section, bull or bear. Let's look at how the institutional market is completely dividing on valuation and timing.
Now, impartially, both sides of this trade are looking at the exact same data. The bull thesis argues this is a brilliant, calculated offensive, a deliberate choice to capture Latin America's massive offline to online shift before competitors can even get a foothold. The bear thesis, on the other hand, which notably includes heavyweights like UBS and JP Morgan, argues that this heavy investment cycle has no clear end date. The disagreement isn't really about the quality of the business, it's entirely about the timing of the payoff.
To contextualize what the upside actually looks like if the bulls are right, let's examine the ticker advanced valuation model. Comparing the current price in the 1800s, their mid-case model projects a massive potential target price of around $8,302. That represents a potential 351% total return, or an annualized IRR of roughly 38%. But, and this is a huge but, that assumes operating leverage eventually returns, fulfillment costs normalize, and net income margins recover to around 11%.
It's absolutely vital to highlight that this bullish mid-case relies heavily on the success of the investments they are making right now. It assumes a 21% revenue compound annual growth rate all the way through 2030. It demands that these free shipping investments actually compound buyer frequency and that the credit card book matures into solid profitability. If this heavy investment cycle extends into, say, 2028 without a margin recovery, well, that massive re-rating gets severely delayed.
Look, Mercado Libre has delivered 28 consecutive quarters of above 30% revenue growth. That is wild. They are aggressively spending to own heavily underpenetrated digital commerce and financial markets. But ultimately, synthesizing all this data leaves us with one final provocative question. Does the institutional market have the patience to wait out this deliberate investment cycle? Or are the bears going to win the timing game?